Well, Magna International, one of our big auto parts makers, of course, missed expectations in its first quarter, but exceeded on revenue. So missed on earnings, beat on revenue. Let's get more on the company's results with an analyst who covers the stock. Michael Glen is managing director at Raymond James. This is a difficult environment, Michael. First of all, thank you for joining us. This is a difficult environment for the parts makers. How did Magna do in its most recent quarter?
So relative to consensus expectations, the results were below what the street was forecasting, which is why you're seeing the pressure on the stock today. Outside of that, they did lower their margin guidance for the full year, citing some currency-related headwinds, as well as some tariff-related items as well. I don't think people's expectations heading into the result were exactly aggressive. I wouldn't characterize them as that, but clearly the results offered this morning were disappointing.
Did the company on its conference call, which began at 8 a.m. this morning, did it talk about tariffs and how tariffs might affect its outlook?
There was a lot of questions surrounding tariffs and what the impact of tariffs would be. Management offered some degree of guidance in terms of how to think about it. They specifically highlighted about a $250 million headwind that analysts should be thinking about in terms of what has been proposed up till now in terms of tariffs. So that's helpful in terms of modeling for the business going forward.
How is the company doing on content per vehicle, which is a key metric at Magna? The company has a long history of increasing its content per vehicle.
It's an interesting question, Paul, because it was a metric years ago that the company used to disclose. They haven't really disclosed to us exactly content per vehicle for a period of time. What they did speak about this morning, though, was that content per vehicle in North America is about $1,300, with above corporate margins for the overall business. That's consistent with what we used to see them report when they used to break this out for us explicitly. And the other item that they did highlight, and I think most people had an understanding of, is that European margins for them does remain, is below the corporate average. So they earn a lot of money on pickup trucks, SUVs in North America. They're well aligned with General Motors here, and that's a very profitable business for them.
You say in your note on these results that the share price is really dictated these days on headlines regarding trade and tariffs. How should investors understand that? Should they just, if they don't own this stock, should they just stand back until some clarity is reached on tariffs and the automotive sector?
We have a hold rating on the stock. We've had a hold rating for a while. The tariff issue is big. It's meaningful. People need to understand that there will be volatility. So our overall recommendation would be to be patient for some clarity on these tariff-related items. Specifically, the one that is still lingering is with regard to assembly operations in Mexico and Canada. That's a big one that we're waiting for clarity on. The tariffs associated with vehicles that are assembled in those two markets. So this is something, hopefully we get some clarity on this in coming weeks, but I would tell investors to be patient and wait for some constructive news on those fronts.
Okay, what is the big macro backdrop looking like? Before trade became the dominant narrative, one of the worries on this stock was that global auto production was not growing as it had in the past.
So that still remains. I would be very clear with you on that. And one of the fallouts from what we're seeing with the tariffs, okay, is that vehicle prices will remain high. If you go back to pre-tariffs, affordability was a substantial issue So vehicle prices are very close to all-time highs right now. Incentive levels have not quite returned to where they were pre-pandemic. So buying a new car, for anybody who's gone to a dealer lot, knows that buying a new car is quite expensive right now. So that dynamic is unlikely to change. It was not changing pre-tariffs, and with tariffs, it's absolutely not going to change. So that remains a big underlying situation that will keep production capped, is just the affordability right now. And the OEMs, to be clear, the OEMs in North America have shown little desire to increase production in order to and compete more readily with more aggressive incentives in the market.
Michael, thank you so much for joining us today on a high-profile stock here in the country, Magna International. Michael Glen is Managing Director at Raymond James. Up next, we'll get a check on Canada's tourism industry ahead of the summer season as more Canadians, of course, decide to stay home.